Hello, everybody. This is episode 17, Balance Sheet Liability. This is Value Investor TV podcast that helps you grow your wealth and become financially independent. My name is Becco, and my partner, Hari. All right, episode 17, guys, Balance Sheet Liability. In the previous episode, we talked about balance sheet assets, right? Assets, again, balance sheet, kind of going back to our previous episode, a balance sheet broken down into largely two different segments. First is the asset part. The other side is liability and equity. So we talked about the first part in the previous episode. This part, we're going to talk about the other side, which is liability and equity.
Yep.
Okay, why don't we just dive right into this in this episode? So after asset, we come to liability.
Yep.
So give me the breakdown of liability, just like we did in the asset part, please. Sorry.
So it follows the same convention, right? Is how quickly does that liability have to be paid? So current liabilities versus long-term liabilities. Current are less than 1 year; they have to be paid out.
Mm-hmm.
And in long-term liabilities, it's greater than 1 year. So it may be 13 months, it may be 13 years,
Yep.
but it is still greater than 1 year.
Mm-hmm.
And when you start looking at it, it mirrors, it has very similar concepts to what you would see in the assets. So just like a company can get, has an asset for accounts receivable, which essentially tells you I have to get paid because I've sold my customer a good. I'm going to get money back in the next 30, 60, or 90 days. You also have accounts payable, which is 30, 60, 90 days, however much the company decides, their suppliers will ship them an item and they have to pay for that item in that time frame.
Yep.
And so in the case of, things that are purchased on this like short-term credit, and typically when these offer these short-term credit deals, they're not charging interest or anything like that. This is just to help the supply chain, move faster.
Yeah.
Is they ship the goods and then they just send them a PO to get purchased. Where this becomes a problem is that your creditor may not, the person making supplying you these items may not feel comfortable with the safety of your balance sheet. And so what they may say is, we're going to sell it to you, but you have to pay us up front because we don't want to get a bunch of items that we ship to you and then we never get paid for. So think about right now, Sears is in active talks about bankruptcy.
Yeah.
For the last 6 months or a year, their suppliers haven't wanted to give them any items on credit because they were worried about actually getting paid for it. So that's what accounts payable is, and it falls into this this category of things that I have to pay for the items that I have purchased. So they are due fast, sooner than some of the, as we go down the line here. So one of those is accrued expenses. So think about accrued expenses are things like wages that you owe your employees. So you don't pay your employees every day. I mean, some businesses do, but most businesses don't. They pay 14 days, 28 days, depending on, what the business is or how they've set it up. They may also have expenses that they have to pay for, like rent or so they accumulate this, and they pay rent every 30 days. And so that those are things that fall under this accrued expenses category. So there's not a whole lot to really look into this. I mean, as a whole, current assets, current liabilities. We'll talk about that together here in a little bit. So what I think about from these two categories is accounts payable is something that if a successful business who has control over their suppliers may be able to bring better concessions on this. So think about Costco. They may not, they say we're enormous. We can sell all of these goods whenever, quickly. So they may get credit for 90 days. So they may actually get the item shipped to them, sell the item before they even have to pay for it. And so they don't have to actually, spend any money to hold inventory in their stores. That's a huge advantage from a cash flow perspective. And that's something as a value investor you should learn to appreciate, because that means that they're able to do more with less money than a competitor.
Mm-hmm.
Okay, so moving down the balance sheet,
Yep.
To is current portions of long-term debt. So think about it. When we talked about debt and equity, we borrowed money from our from the bank, and they said they gave us $100, and they said you have to pay a 5% interest rate. So the current portion of the long-term debt is what is due this year for that long-term thing that we took out a 10-year loan or a 5-year loan, and every year we have to pay 15 or 20 or 25%, however the math works out for that. And that is what appears in this section in the balance sheet. It is specifically the principal that is due this year, not necessarily the interest. Interest actually falls into the category above as accrued expenses. So just be aware that they may separate those things out.
Moving down, do you want to talk about the
last section? The last one is income taxes payable. So we're still in the current liability section. So businesses have to pay income tax every year, assuming they make money, and sometimes they have to pay taxes for other things like payroll taxes and other non-income based taxes. So those all fall under this. So they may be accumulating all of that, just like you would with your property taxes. You may pay it once a year, but you have a liability that you have accumulated over time.
Right. So again, going back to the overall structure of the liability side of this, just like the asset, it's broken down into short-term, or what we call current liability, and then long-term liability. Current liability is what just Hari bullet pointed. Account receivable, accrued expenses, current portion of the long-term debt, income tax payable. All these things are current liability due within 1 year. Okay, so let's move on to the long-term liability. These are due not within 1 year. We don't know when, but not within 1 year.
Yeah.
It's a large bucket for that. So Hari, take it away.
Yeah, so the important thing to understand here is that this is something that the company owes, as we talked about, assets are what you own, and liabilities are what you owe. Because these are things that aren't necessarily within the next year, there is a portion of them that appear on the current liabilities depending on what it is. So the long-term debt is debt that we borrowed when we founded the company, or debt that we took on for growth, or paying expenses and so forth. That debt has to be paid within a time period that's specified by the debtor. So that's the bank, or in some cases we issue corporate bonds. So that debt is the principal that needs to be paid back. So if we borrowed $100, that $100 shows up here, and then we make interest payments on that $100, and then we reduce the long-term debt as we pay off the principal on the thing. And then this is another thing that falls under the long-term debt or long-term liability category, is capital lease obligations. So interestingly, if you're like a retail store, you may sign a capital lease, which is a multi-year lease on this property, and that lease is an obligation that you have to pay yearly. And typically the way that works is that capital lease obligations, if you go into bankruptcy, the rent is one of the highest priority payments. So you sign a contract, you will have to pay the renter first before you pay off some of your bondholders and debt holders.
Really?
And so rent is kind of an important one to understand.
Wow.
Which also makes it more valuable to real estate investment companies, because they get paid first in the event of liquidity problem. Now, the other thing about it is long-term debt, typically you have to pay it all off. I mean, you can renegotiate it, pay a price, and then take a longer term or something like that, change the terms. capital lease obligations don't necessarily require you to make the 5-year or 10-year commitment. If a good example of this is retail stores will be in a mall or something like that, and then if the mall traffic or mall doesn't meet certain criteria, the retailer may have the ability to get out of the lease, and so they may have to record the entire obligation on their portfolio, but they may not necessarily have to put it. It may not actually be the full amount that they have to pay.
Right.
So, just be mindful of that, because when you look at the footnotes, which we haven't talked about a lot yet, but the footnotes kind of tell you how much, what is the accumulated, debt for each one of these loans that they've taken out, how long do they have to pay them off, and that kind of stuff. And in that is the capital lease obligations. They will tell you, we have so many leases that are due in 2 years, 3 years, 4 years. Many of our leases we are able to get out of if we don't meet, the mall or whoever is renting to us doesn't have enough traffic to that location.
Yeah.
So important thing to understand is it's not necessarily that they have to pay the full amount for those things.
It's not locked in.
Yeah.
Yeah. So okay, that's a long-term liability that Hari just talked about there.
Yep.
Long-term debt, capital lease obligations. You'll see it when you crack open one of these balance sheets of publicly traded companies. You'll see the long-term liability section.
Yeah. One other one here that is worth noting, and this is usually applies to older companies that have a longer history, is pension liabilities.
Oh, yeah.
So pension liabilities are something that actually fall below, in many cases, they fall below the rent part of this. But I'm not entirely sure where. It depends on the structure, whether they go ahead of the bondholders or below the bondholders.
It's really up there.
Yeah, but they are pretty high up there also in terms of who gets paid first.
Yeah.
But pension liabilities are something that, a lot of companies have a long-term liability there that is not necessarily something that they, depending on, you may offer somebody a pension of, half of their salary for the remainder of their life, which is a fantastic pension. But if they die, then you don't have to necessarily pay that out. Yeah. So, there's different accounting measurements for that, and that's beyond the scope of this talk. Yeah. But just be aware that, older companies may have made some really, crazy promises to their employees in the 70s and 80s and 90s. And then they're carrying these pension liabilities for a long period of time that, they may have to pay out. And that can hurt their business over the long period of time. And, the running joke was, that GM was a pension company that made cars, so, and that was a real problem. Before 2008, they had enormous liabilities related to their pension. Yeah. They declared bankruptcy, and they kind of had to restructure all of that stuff.
Yeah. Man, that's crazy. I mean, similar things going on right now with GE, I believe.
Yeah.
Yeah.
Yep.
Wow. Okay. So that is liability there. Just to kind of wrap it up here. So liability, like we said, broke down into current liability, long-term liability. So as we mentioned in the earlier part of this episode, assets is what we talked about earlier. This part, we talked about liability. So what happens if you subtract liability from asset? This is what we actually own.
Right.
Right. So that's called equity.
Yeah, what the shareholders own.
What the shareholders equity own.
Yeah.
Actually own. So tell us about that, and that will wrap it up in this episode.
Yeah, so the equity is a really important concept because, when you look at the assets and the liabilities and you take away that component on a business that is an ongoing concern, that is not, being liquidated, right? And the shutting down everything and then just selling off the assets, paying off their creditors. The difference is the assets have this value, the liabilities have this value. What does the shareholder actually own, right? And there's two ways of measuring this. One is assets minus liabilities. And there's another way of measuring this that is actually related to how the company was initially funded. So This is called paid-in capital, or capital that was proceeds that were from the sale of stock. So think about our debt and equity. This is the other term that we used earlier, was debt and equity, financing to build our business. The equity component of that was we went to our friends and they gave us $100, and we borrowed $100 from the bank. That $100 is also shareholders' equity, because that $100 was used to finance the company, and in return for paying, we gave shares to our friends, and we got cash that got marked on the balance sheet as well as cash, but it also got marked on the equity side.
Yep.
There's another concept here that is important as part of the shareholders' equity measurement, and this is something that I don't even use a whole lot, but it's in every single annual report. And they usually have a balance sheet. They also have a shareholders' equity section, which is called retained earnings. So retained earnings are the accumulated earnings that a company has over the period of over its lifetime. So when you look at the end of the income statement, we have net income. If you take net income for every single year that the business has been operating, you get what's called retained earnings. Now, the retained earnings that the business has could also include losses for certain years. So those could be negative for some time.
Yeah.
But then the company also pays out dividends to its shareholders, and those dividend payments actually occur as cash disbursements that come directly to you as the shareholder. So if our stock, our hot dog company had 10 shares, and we paid out a dividend of $1 every year, we would subtract that dividend from the retained earnings that we make. So 10 shares, we made $20. So $20 is our net income, $10 is our dividends. Our retained earnings would increase for fiscal year 2018 by $10.
Mm-hmm.
And so that, plus the proceeds from the sale of stock, is also equal to equity.
Yeah.
Right. And so those concepts, the term balance sheet actually is balancing the equity with the assets and liabilities. So assets minus liabilities still equals equity. So assets minus liabilities also equals the proceed from the sale of stock plus retained earnings. So
Yep.
What is interesting about this concept is that if you are the owner of a business, you want to measure how much did this business generate for you in terms of earnings, right? I mean, obviously, businesses exist for the purposes of generating their owners a profit. Think about a company like that's a startup like Uber, who has never generated a profit and has an accumulated loss of $12 billion. So if you were the owner of this business, it would, and this was all cash that you were using, you would have to earn $12 billion before, just to break even at this point. And then on top of that, you'd have to earn any dollar over that is a positive retained earnings. So right now, and this is definitely a possibility, companies can have negative equity. And that means that the assets are smaller than their liabilities, and their retained earnings are so negative that they don't have. Now, there are other things that they use to rebalance, the balance sheet in the shareholders' equity statement, but proceeds from the sale of stock and retained earnings are, how they do that. And so the way that a company like Uber would do it is they would say the proceeds from the sale of stock, which they've had plenty of those, are there to offset the retained earnings.
Retained losses.
Yeah, retained losses in this case.
Yeah.
So there is a flip side to that also, just to be, to talk about the other case, is that if a company sells stock, they can increase their equity, but they can also buy back stock from existing shareholders. So if we went, Hot Dog Inc. said, we have plenty of money, we're making cash because we're, the best hot dog company in the world. We can also take the excess cash that we have and buy shares back from our investors. So think about it from I have a pie with 10 slices, I make $10. Now I reduce the number of slices from 10 to 5. then everybody basically doubled their earnings without the company really changing anything else. So it's really, a lot of people on Wall Street and things like that say that this is financial engineering and all that stuff, and it's not real and whatever. Should never enter your mind as an investor. The only thing that should matter to you as an investor is on a per share basis, how much are you making?
Yeah.
So if there's 100 shares and now they're 50, bully for you. You made twice as much for doing, now could they have paid that as a dividend or something else? Those are different discussions, but on a per share basis, you always want to make more money. So
Right.
Is that through growth or is that through decreasing the share count? It shouldn't matter to you as an investor.
Yeah. I want to summarize that part really quick.
Sure.
So equity, again, we talked about this equation. Equity equals asset minus liability. This is what you actually own after you pay out all the
what the shareholders own.
All the shareholders own.
Yeah.
Right. And that is also equal to retained earnings plus paid-in capital.
Yep.
So just keep that in mind as you move forward in your investor journey. That this is very important to understand. And also, this equity idea, this is also book value. This is what the shareholders actually own.
Right.
And so book value means this is actually what the shareholders actually own. And so Hari talked about stock buybacks as a way to increase the per share value of things. Easy way to understand it is a slice of pie. You have a slice of pie. Instead of slicing the pie into 10 slices, you could slice it into 9 slices. So one slice is more of the pie.
Yep.
So that's what stock buyback is doing in essence. And so a lot of times you'll see book value per share. Like per share book value is a lot of times what companies will report. A lot of the times investors will look at that and compare that to stock price.
Yep.
And we talked about this earlier in the income statement as well. Earnings per share or revenue per share. So per share basically means get equity and divide it by number of shares to get one slice of pie because it's easier comparison if you do per share everything.
Right.
It's also what you actually own as a shareholder.
Yeah.
So it's important to understand that too.
And it also helps you compare that against the price, which is on a per share basis also. Right.
Yeah. Exactly. Okay. Anything else you want to add here, Hari?
No, I think that pretty much covers it. The balance sheet is critically important to financial health.
Yeah.
Understanding the financial health, and I think these terms. Every annual report, you will see these terms. So you can if you're trying to really get yourself familiar with this, the best thing to do is really just go and get an annual report and start looking at the financial statements, and you'll see all of these terms. And hopefully, you can re-listen to this podcast if you're not sure, or look it up online to kind of hammer home what they all mean.
Yeah. Also, I want to point out one more thing. As you were saying that, it just came to my mind. This asset, liability, and equity, they will come back when we talk about valuation metrics.
Yeah, absolutely.
This is very critical to understand. I'm sure if you've been listening to news or reading newspapers, people talk about return on asset or return on equity, return on book value. All these things, this is what they're talking about. This is return on asset, like we talked about in the balance sheet asset. Return on equity is the equity part. So we'll talk about that in more detail later down the podcast.
That happens to also be the most important metric in
very, very important
investing. So just be aware, or one of the most important.
Yeah.
So when we do talk about that, this is a good podcast to come back to just to understand what does equity actually mean.
Yeah.
Because it will be very critically important to, valuation and profitability.
Mm-hmm.
Those are the two most important concepts in value investing.
Yep. Okay, we'll talk about those, the valuation metrics later. But for now, let's close this podcast out. So thank you guys for listening. This podcast was episode 17, Balance Sheet, Liability, and Equity. If you like the episode, please do subscribe to our channel, and leave us a comment on YouTube or wherever it may be, or shoot us an email at info@valueinvestor.org, or find us on Twitter or Instagram. We're on there as well. Okay, well, thank you guys for listening. I'll see you on the next episode.
Thanks.